Hi girls, in today's class we are going to see this topic Narasimham Committee Report on Banking Sector Reforms. Alright, so this topic is basically about the reformation that which was brought about in the banking sector. So we have been seeing in this chapter commercial banks, various topics in commercial banks like the functions of commercial banks, role of commercial banks, the investment policy of commercial banks. Now, to continue with the same chapter, the next topic that we are going to see is Narasimham Committee Report on Banking Sector Reforms. Okay, so before I go in details with this topic, let me give you an introduction to this topic. So, what exactly is this Narasimham Committee Report? Okay, so let me tell you about this Narasimham Committee Report. Now, during the year 1960 and 70, many banks in our country were nationalized. So, what is the meaning of being nationalized? Nationalized means to change the banks from or convert the banks from private to state, or private to public sector. So, conversion of the banks from the private sector to the public sector, or rather from private undertaking to the government undertaking, is what is called as nationalization. Alright, so in this year 1960, 1970, in that particular decade, 10 years time, many banks were nationalized. And this made India to borrow funds from International Monetary Fund and World Bank. In order to meet their financial requirements, India borrowed funds from these two international financial organizations. Now, after they borrowed money, what happened was there were certain terms and conditions that which was put by these IMF and World Bank. Stating what? That if only these rules and regulations were complied with, they will provide them with financial support. So certain conditions were put by IMF and World Bank. So as a result of which, your banks, your government had to undertake, these kinds of policies, conditions in order to avail the financial help from IMF and World Bank. So after they have taken the loans from IMF and World Bank, so India was put into such a state that it had to bring about some sort of a reformation in the banking sector in the country. So what do you mean by reformation? Reformation is to make some sort of changes in order to improve the banking operations in the country. Alright, so they wanted to make some kind of changes in order to bring about improvements in the output of the banking sector, so that they would be able to pay back the debts that which were taken from IMF and World Bank. And not only that, even the terms and conditions which were put by IMF and World Bank compelled our banking sector reforms, banking sector to be reformed. Is that clear, girls? So this is what is the basic introduction to Narasimham Committee report. Alright, so this only recommended the government of India to set up a committee. Alright, so under the chairmanship of M. Narasimham, who was the ex-governor, the committee was set up in the year 1990. So along with M. Narasimham, the ex-governor of Reserve Bank of India, there were few more people, added to the committee, and there was a committee which was formed in order to study about the banks and also to bring about some kind of a changes in the banking sector in order to improve the banks in the country. Alright, so actually talking, there are two different types of committee reports. So one which happened in the year 1990 and another one which happened in the year 1997. So in 1991, the first committee report was given. And in 1997, again another committee was appointed. Alright, see, the first committee was appointed by Manmohan Singh, who was the Prime Minister then of the country. Okay, so Manmohan Singh appointed the first committee under the chairmanship of M. Narasimham. Alright, that is in 1990. In 1991, there was a reformation that which was brought. And then second one was appointed in the year 1997. Now this time it was appointed by P. Chidambaram, who was a finance minister, okay, of our country at that time, during 1997. Alright, so that second one came to be known as Narasimham Committee 2. Okay, so first one in 1991, it was called as Narasimham Committee 1, and second one is called as Narasimham Committee 2 in the year 1998. Alright, so these are the two different committees. So let's see what are all the study, okay, and research that which was done by this committee, and what are all the reformations which was brought, okay, in the banking sector by these committees. So we are going to see this topic in two heads. One is Narasimham Committee Report 1, okay, 1991, and another one is Narasimham Committee 2, 1998. Okay, so let's see what these two reports brought forth as a changes in the banking sector in order to improve the banking sector. Okay, so this particular committee was set up mainly to study what were the problems of the Indian financial system, what were the problems of the Indian banks, and then they came up with some kind of recommendations meaning some sort of opinions, okay, in order to improve the efficiency and productivity of these financial institutions. Okay, so let's see what were those recommendations which were brought by this particular committee number 1. Okay, Narasimham Committee Report 1. So first one is they wanted to reduce the SLR and CRR. Okay, they wanted the government or the Reserve Bank of India to reduce the SLR and CRR for the commercial banks. So what is this SLR and CRR? SLR is nothing but statutory liquidity ratio. And what is CRR? CRR means cash reserve ratio. So the first recommendation which was made by this particular committee is they asked the Reserve Bank of India to reduce the SLR and CRR for commercial banks. So SLR means, like I told you, is statutory liquidity ratio. Now if you remember what is this liquidity all about, I told you when I was teaching you all about the investment policy of commercial banks, when I spoke about liquidity, I told you two different perspectives can be called as liquidity. First perspective is cash in hand. Okay, so cash in hand is called as liquidity. Another perspective is investing your money in liquid assets like gold, like government securities. So that is also called as liquidity. These are two perspectives. One is cash in hand. Another perspective is to invest in most liquid assets like gold and securities. Okay, so that which can be immediately converted into cash without much loss. Alright, so that is what is liquidity. So what do you mean by this reducing the SLR? See, there was a rule that which was made by Reserve Bank of India that a certain percentage, okay, a certain portion of the capital of the banks should be kept in liquid state. Okay, so if, say for example, out of 100%, 40% should be kept in liquid state. This means what? If it's kept in liquid state means for the banks, that means that 40% is not available for making profits. Okay, remember I taught you liquidity and profitability. So if you have more of your investment in liquid form, you cannot make profits. Do you understand? But rather if you go ahead investing in investments like loans and all that which are not easily convertible into cash, then that is going to give you a lot of profits. So the logic is if you have more of liquid assets in hand and liquid cash in hand, you won't be able to make profits. So this was a problem for the commercial banks to make profits. So the first recommendation that was made by the committee was asking all the banks, asking Reserve Bank of India to reduce the statutory liquidity ratio. Okay, the ratio of the assets which was supposed to be kept in cash or in liquid state should be reduced. Like for example, I told you 40% should be kept in cash, isn't it? So that only 60% is available for investing for profits. But now they reduced. They told, okay, 25% you can keep in. This is just an example that I'm giving you, girls. I'm not giving you the exact ratio, just an example. So now they wanted to reduce, say for example 25% you can keep in cash, remaining 75% is available for investment in order to make profits. So that is what is called as reduction in SLR. Alright, then they also wanted to reduce the CRR. So what is CRR? Cash reserve ratio. Cash reserve ratio means, see, every commercial bank were compelled to deposit some cash with Reserve Bank of India. Okay, a certain portion of their deposits should be investments should be deposited as cash with Reserve Bank of India. Say for example, out of 100%, 10% or rather 15% has to be deposited with Reserve Bank of India in the form of cash. Like how all of us open an account with commercial banks and keep our money there, no? Like that, commercial banks should open an account with Reserve Bank of India and they should deposit some money with Reserve Bank of India. So that is what is the cash reserve ratio. So that also the committee wanted to reduce, because if they are asking more of cash to be deposited with Reserve Bank of India, it is understood that that particular cash is not available for investment for commercial banks. So if 15% has to be deposited with your Reserve Bank of India, means only 85% is available for investment with the commercial banks. That means again that will reduce their profits. So they also asked this CRR to be reduced, that is a cash reserve ratio to be reduced, so that banks have more of investments in their hand for their investment. Okay, so this was the first recommendation which was made by your Narasimham Committee Report 1, asking Government of India and Reserve Bank of India to reduce the SLR and CRR so that the profits of these banks will increase. Followed, girls? The next point that we have to see is, the next recommendation is pacing out directed credit programs. Okay, I will summarize these points for you. Pacing out directed credit programs means, see, pacing out basically means stopping. Alright, see, Government of India, before this reformation, Government of India had compelled many banks to come up with lot of credit programs, especially for the poor people and the needy people. Okay, like for example, they were also forcing the commercial banks to provide loans in the rural areas, in the for the poor and the needy people at concessional rate of interest. Okay, so what do you mean by concessional rate? Means reduced rate of interest. So normally if the rate of interest for loan, okay, see, if you are going to take a loan from a commercial bank, you have to pay in return what? Interest. Okay, so that interest rate was asked to be reduced for poor and the needy people. Okay, like for example, say if 15% was charged basically for a loan by commercial banks, they told the commercial banks, that is Government of India asked the commercial banks to